Bismillahirrahmanirrahim. I'm Dr. Wajid Alim. The topic today we want to discuss is the position and function of a derivative market. Here we will discuss that where the derivative market exists and what are the various function of a derivative market. So first of all, we have the financial market, and financial market means that market where the financial instrument can be traded. The financial instrument may be bond, shares, interest rate, currency, etc. All these are the financial instrument through which sale and purchase can be carried out. So these type of market is called the financial market. The financial market is divided into two types. One is the money market and second is the capital market. Within the money market, those securities are traded whose maturity is less than 1 year, while in the capital market, those securities or shares or bonds are traded whose maturity is above 1 year. Again, we have two types of the capital market. One is that market where shares and stock of a company can be traded, and that market is called the stock exchange. While the other market where bond, which is also one of the financial instrument, so where bond can be traded, is called the bond market. So capital market is further divided into two types, that is stock exchange and bond market. The stock exchange, as we are focusing on the stock exchange because we want to unveil the position of the derivative market, that where the derivative market exists. So further we have divided the stock exchange or shares market into two types. One is the primary market and second is the secondary market. Primary market or IPO means initial public offering. Primary market or that market where the shares and stock of a company are traded for the first time. Whenever the company issue its shares for the first time, so it must be traded or it can be traded in the primary market. That primary market may be any sort of intermediaries, any financial institutions, broker, etc. All these may include in the primary market where the initial offering or first time issue of a company can be traded. Secondary market is that market where the already issued shares of a company can be traded. It means that whenever the company issue its share for the first time, it will be traded in the primary market. After that, that share will be traded in the secondary market, and the secondary market is the stock exchange. Again, in the secondary market, we have two types. One is the derivative market and other is the spot market or cash market. Spot market or cash market means where investor can sell and purchase through cash. Means that through this within the stock exchange, if you have to purchase some share, you must need to have an account in the stock exchange. You must have to fund in that stock exchange. From your account, you can sell or you can purchase shares or stock of a company. So within the spot market or through cash, you can sell and purchase share of a company. The other is the derivative market, which is for the future, whose price are settled today. The price and quantity is also agreed by the investor today, but the contract will be exercised in future, so that market is the derivative market. So as a whole, from this picture, I'm trying to clear it that the position of the derivative market exists within the secondary market. When in the secondary market we have spot market or cash market, and the other type of the market in the secondary market is the derivative market. So this is the clear position of the derivative market within the picture of within the tree of the financial market. Further, we have various characteristics of a derivatives market. The first one is there is no actual buying and selling exist. Means that if you enter in a contract to sell and purchase some shares, then you will only receive or pay the difference of the price. If the price is set at 100 and at the exercise date the price become 105, so either you will receive $5 or you will pay $5. So you have to either receive the difference or pay the difference. There is no actual selling and buying of share exist. Matlab, it means that actually you will not deliver the share and stocks. You have only to pay or receive the difference. The second important characteristic of derivative market, that there is no limit to the number of unit transaction. Means that you may enter in one contract, you may enter in two contract, you may enter into three, and so on. So there is no limit for you that how much contract you want to enter. It exists only the secondary market securities. It means that within the derivatives market you can only enter in a contract on those commodity whose are the secondary market securities. The last characteristic of derivative markets is this can't be used in raising fund. Like whenever the company issue shares or stock, so the main purpose of the company is to raise fund for the company. So the main purpose of the derivative markets or derivatives contract doesn't mean that it will used for raising fund. Next is the functions of derivatives. These are the various important and vital functions of derivatives. That it reduce the transaction cost, because no transaction cost exists here in the derivative market. It reduce the risk of transfer, as we have already mentioned in the characteristic that there is no actual buying and selling exist. So there is no transfer of commodity, there is no transfer of any sort of instrument. So it reduces the risk of transfer the commodity. This derivative market enhance the price discovery price, because whenever you want to enter in any sort of the derivative contract, you must discover, you must predict, you must forecast the actual or precise price in the future. So this need a complete analysis. After that analysis you will enter in a contract. So here the analysis are involved. That's why through derivative market one can easily discover the accurate and actual price which may be in future. It also provides a signal to market moment that how or in which direction the market will move in near future. And the last two important point for the function of derivatives, that it enhances the liquidity to the underlying assets. Here the underlying asset through which the derivative contract may be exercised have a very high liquidity, or those securities through which you may enter in a derivative contract. So the liquidity of that security may be very high after the derivative contract, and it also show the market efficiency. Here are the various risk which involve within the derivative markets. That risk may be the counterparty risk, which we have discussed in the forward contract, that if two investors enter in a contract and one of the investor later on deny from the contract, so it is a very high risk which exists from the counterparty to the other investor, that the investor or the opponent investor may deny from the contract. The second is the price, because price variation are very high and you predict or forecast price for the future, so there may be a chance of decline or rising the price, so the price risk also exists within the derivative market. Next is the agency risk. Agency risk means that most of the derivatives contract are carried out by the broker, so there must be or there may be a contract exist between the investor and the broker, so which will create unbalance between these two, between investor and broker. So agency risk or the conflict of interest between broker and investor is also one of the most prevalent risk exist within the derivative market. Next is the systematic risk. Systematic risk is also one of the most important risks within the derivative market, that the government policy may change in any direction, so which will affect the contract of the investor. Hope it will clear to all of you. Thank you.